Hello guys, welcome back. Can you all hear me? Good day. So I hope you people had a good day. Well, there were so many students, and it took me more than an hour to add everyone. First, I had to add all of you to my phone book, and then I had to add you to the group. So I'm extremely sorry if I have missed anyone, but I will add you people today, whoever is left. So did you people go through the assignment? Did you people go through the assignment? Okay, so let me solve it now. But before I move towards the question, first let's discuss receivable management and have a quick recap of receivable management. Well, you don't need to manage receivables if you don't offer receivables, right? If you do not offer credit, you don't have to manage receivables. Simple. But when a company offers credit to its customers, then it has to manage the receivables. There are costs attached to offering credit to customers, and there are also benefits of offering credit to customers. Offering credit to customers will attract more customers and it will increase company sales. But on the other side, offering credit will bring some costs to the business. Number one, it will increase the administration cost of the company. Number two, it will increase bad debts. Number three, it will increase finance cost of the company. So these are the costs that the company has to bear against the benefit that it is going to receive in the form of additional sales. So I'm not sure if the problem is at my end or it's at the student's end. Can you people hear me? Okay, that's probably the problem with the students. So, so if when a company has to decide whether it should be offering credit to its customers, it has to have a cost benefit analysis. It has to look at the benefit that it is going to receive and also the incremental costs attached with giving credit to the customers. Let's discuss this Ulnat company question and you will get a better idea of how we do this analysis. Ulnat company has annual sales revenue of $6 million and all sales are on 30 days credit. Now here in this question, the credit is already offered but that is only for 30 days. Although customers on average take 10 days more than this to pay. Now the stated policy of the company is 30 days credit period. But the customers, they pay 10 days, they take 10 days more to pay, which means that the credit period that they actually enjoy is of 40 days, right? Now just stop for a while. That's a very important point. My question to all of you is, should I use 30 days for my calculation or should I use the 40 days figure? Okay, great. Now everyone, excuse me, remember what credit policy do we have on books? It won't matter. The policy may be of 30 days, but if the customers are effectively taking 40 days to pay us back, then 40 days should be considered for calculation's sake, right? So we should not go for what is the credit period on the books. We should always consider the actual credit period enjoyed by the customers. So most of the students, they will make a mistake here. Contribution represents 60% of sales and the company currently has no bad debts. Account receivables are financed by an overdraft at an annual interest rate of 7%. Ulnat company plans to offer an early settlement discount of 1.5% for payment within 15 days and to extend the maximum credit offered to 60 days. The company expects that these changes will increase annual credit sales by 5% while also leading to additional incremental costs equal to 0.5% of turnover. The discount is expected to be taken by 30% of customers, while with the remaining customers taking an average of 60 days to pay. Evaluate whether the proposed changes in credit policy will increase the profitability of Ulnat company, and that's what we have to do. So let's go through it. So the first thing is to calculate the benefit. One of the benefits is the contribution, the additional contribution that we are going to get. So if we extend this credit, what will be the increase in sales? The company expects that these changes will increase annual credit sales by 5%. So the additional sales will be 5% of the existing sales figure, that is $6 million. So $6 million into 5%. So that's the additional sales. Sorry, that's the additional contribution figure. So this is the benefit that the company is going to get if it extends its credit period for a normal credit period to 60 days, right? Okay, now if it does so, it says that it will lead to incremental costs equal to 0.5%. Sorry, I have just calculated the incremental sales figure. So 6 million multiplied by 5% will give us the additional sales figure, and we need to multiply it by the contribution ratio, which is 60%. So let's multiply it with 60% as well. So we'll get the additional contribution figure, which is $180,000. Now, what will be the costs? One of the costs will be the incremental cost. Probably it might be because of the administration. So it says that the costs will be 0.5% of turnover. So the additional cost will be 0.5% of turnover, and the revised turnover will be 6% plus the additional 5%, right? So I'm just taking 6 million plus the additional 5%. So I'm picking up 6 million and I'm increasing it by 5%. So I have to multiply it by 1.05. So by multiplying the 6 million figure with 1.05, I will get the revised sales figure. And when I multiply it by 0.5%, it will give me the incremental cost figure. So it's 31,500. Now, a quick question from all of you. What other costs will be incurred? What additional costs will be incurred other than the one that we have just mentioned? Okay, so one of the very obvious costs will be the discount. Okay, how much discount is being offered? 1.5%. And what proportion of the customers will be taking this discount? 30%, right? Okay. Excuse, excuse me, I'm okay. 30% of sales, right? So should I take revised sales figure or the existing sales figure? Yes, revised sales figure. So revised sales figure will be 6 million into 1.05. So that is the revised sales figure. And since 30% of the customer will take discount, so I took 30% and then multiplied with the percentage of discount. So the additional, so the discount will be 28,350. Okay, what other costs should be considered? Finance cost, yep. Finance cost. Okay, now first I'll just solve and calculate finance cost separately, and then I'll show you how to calculate it in a single cell. First of all, we need to calculate the existing receivable figure. The existing receivable will be equal to 30 days sales, because the credit period is of 30 days. If your credit period is of 30 days, your receivable figure will be equal to 30 days sales. That's something that we discussed yesterday as well. So the annual sales figure, existing annual sales figure is 6 million, right? So if I divide it by 365, it will give me a daily sales figure, and then I have to multiply it by 30 to get receivable balance, which is prior to this policy, 493150. So that's the receivable balance before the policy is offered. Now after the policy, there will be two types of, okay, I'm sorry, that's my mistake. It should be of 40 days. I just forgot. It should be of 40 days. Thank you for correcting me. So that should be of 40 days. Okay, that's our existing receivable figure. Now, with the revised receivable figure, we have to do it, we have to calculate it twice, because now there are two types of customers: the ones that are paying us in 15 days and the ones that are paying us in 60 days. So first, let's calculate revised sales figure so that we don't have to calculate it again and again. The revised sales figure will be 6 million into 1.05. So that's the revised sales figure. So receivable balance paying in 15 days will be equal to 15 days sales. So sales divided by 365 into 15 days. And then those who are paying us in 60 days. Okay, now, as you know, that what percentage of customers will be paying us in 30 days? Sorry, 15 days. What percentage of customers will be paying us in 15 days? 30%. So we should also take 30% of this figure. And those paying us in 60 days, right? The revised sales figure, 630 into 70%, because 70% of the customers will still pay us, will pay us in 60 days. So that will be the 70% mark. And then we should divide it by 365 to get the daily sales figure, and then multiply it with 60 to get the receivable balance of 60 days. Here we go. Now the revised sales figure will be the sum of these two. So the sales, that is the revised receivable. Now the additional sales will now be 145068. So we have additional receivable figure of 145,068. Because of the increase in account receivable, we will have to bear additional finance cost, and the finance cost is 7%. So we should take 7% of this figure, and that's our additional finance cost. So we can just simply link this cell here, and we can just take this to here and show it as working 2. And that should be shown as working 1. Right? So, okay, let me give you a quick recap. Just hold on. Let me give a quick recap. The first thing is to find out the additional contribution. The additional contribution will be calculated by multiplying the existing sales figure with 5%, and this will give us the bracket figure is going to give us additional sales. And then we will multiply it with the contribution to sales ratio to find out the additional contribution, which is 180,000. Then the question says that there will be additional incremental costs of 0.5%. So we took the additional sales figure and multiplied with 0.5% to get the incremental cost of 31,500. Discount is 1.5%, but this will only be applicable to 30% of the revised sales figure. So 6 million into 1.5, that's the revised sales figure. Since only 30% of the customers will be taking this discount, so I have multiplied with 30%. And then I've taken 1.5% of this figure to calculate the discount. For the finance cost, we should always calculate the difference between the two receivables, the receivable balance before the policy and the receivable balance after the policy. So existing receivables are equal to 40 days sales, because current customers, they are taking 40 days to pay us back. So the existing sales divided by 365 to get the daily sales figure, and multiplied by 40 to get the existing receivable balance, and that's equal to 657,534. Then the revised account receivable balance will be split into 2 parts. The ones that are paying us within 15 days and the ones that will be paying us in 60 days. 30% of the customers will be paying us in 15 days. So I've just taken 30% here, and I have multiplied it with the revised sales figure, which I have calculated here, 630,000. So 630,000 into 30% will give us the 30% part of the sales figure. So 30% of the revised sales will be paying us in 15 days. And then I divided it by 365 to get the daily sales figure, and multiplied it with 15 to get the receivable balance of those paying us in 15 days. The 70% of the customers will pay us in 60 days. So I've just taken 70% of the revised sales figure, divided by 365 to get the daily sales figure, and multiplied it by 60 to get the sales figure, the receivable figure of those who will be paying us in 60 days. And the total revised receivable figure will be equal to 802,602. That's the revised account receivable. So before the policy, our receivable balance was 657,534. After the policy, it's 802,602, and the addition in the receivable balance is 145,068. With this addition, our finance cost will increase at a rate of 7%. That's the borrowing rate of the company. So it will lead to an additional finance cost of 7% of this figure, which is 10154. And I have put it here. Now, is there additional, any other additional cost attached? Just quick answer. So let's then add all these costs. So that's our total additional costs. And the benefit is 180,000, whereas the additional costs are 70,000. So net benefit will be 10,995. So what do you people think? Should this policy be implemented? If this policy is implemented, it will lead to an increased profit of $109,995. Therefore, it should be implemented. So that's how we evaluate any of our receivable management policy. Okay. Now there's another question. It's a bit difficult question, but a very good question for practice. So I'm just giving you 10 minutes to give yourself a try, and then I'll solve this question for all of you. This P&P question, right on your screens. It's there in the handouts. It's there in the Google Classroom as well. So if it's not there, then you can just simply take screenshot of the question that is just displayed on your screens. Okay, let me increase the screen size and take the screenshot in two parts. Okay, just take the screenshot and I'll just drag it down for you to get another screenshot. Don't worry, Hamza. I'll just share Google Classroom link on the WhatsApp group and you people can access all the notes there. Aisha, don't worry. Just drop me a message on WhatsApp. I'll just add you. Did you people take the screenshot? Okay. Okay, let's solve now. What we have to do actually, it's calculate the net benefit or cost of increasing the discount for early payment and comment on the acceptability of the proposal. So the sales figure, the receivable variable cost figure, inventory, receivable, and payables, they've been given. And we have a segmental analysis of all of our receivables. And what is actually going to happen is the receivable balance given are before taking any account of bad debts. All sales are on credit. Production and sales take place evenly throughout the year. And current sales for each class of receivable are in proportion to the relative year-end balance before bad debts. And we have foreign account receivables as well. So it has been proposed that the discount for early payment be increased from 1% to 1.5% for settlement within 30 days. It is expected that this will lead to 50% of existing Class 2 receivables becoming Class 1 receivables, as well as attracting new business worth $500,000 in turnover. The new business would be divided equally between Class 1 and Class 2 receivables, and fixed costs will not increase, and the rate of overdraft is 8% per year. And we have to calculate the impact of this discount on the profit of the company. Okay. So firstly, the first benefit will be that the business will attract new sales, and this sales figure will have additional contribution. So let's straight away calculate the additional contribution figure. So before I calculate the additional contribution, first let's calculate the contribution to sales ratio. We call it CS ratio, right? So that will be calculated by dividing the contribution by sales. So the contribution will be sales minus variable cost. So sales figure is 5242 minus 3145. 3145. So if we subtract variable cost from our sales, it will give us contribution. And in order to find the contribution to sales ratio, we have to divide it by sales, 5242. And let's put percentage sign. So it's 40%. Now the contribution to sales ratio is 40%. So the additional sales, which is $500,000 multiplied by 40%. So that's going to be our additional contribution. So this is the benefit that we are going to receive if we offer this discount. Okay. Now, will there be any uh, increase or decrease in finance cost due to this policy? So there will also be a change in finance cost, right? Okay. So how are we going to calculate this impact? First of all, let's calculate revised account receivable. Revised account receivable, class 1. So will there be any change to class 1 receivables? Will there be any change in class 1 receivables? Yes. The class 1 receivable will change because of two reasons. One reason is that the class 2 receivables will be becoming class 1 receivables. 50% of class 2 receivables will be becoming class 1 receivables. Number one. Right? And secondly, the new additional sales will also be split between class 1 and class 2 receivables. So there are two reasons why class 1 variable will change: the conversion of class 2 receivable into class 1 and the new account receivable balance created because of the additional sales. Okay. So first of all, the existing balance will remain the same, and that's 200,000. And then we have additional account receivable because of the additional sales. The additional sales figure will be 500,000, and 50% of this will be converted into class 1 account receivable. But my question to all of you is, should I just simply take 50% of 500,000, or should I convert it into a receivable balance? Yes, I must convert this figure, because 500,000 is not the receivable balance, it's the sales figure. It's the sales figure, and 50% of this sales figure will be converted into the class 1 receivable. And in how many days class 1 receivables pay? They pay us in 30 days, so it should be converted into 30 days. So all I can do is to multiply it by 30 and divide it by 365. So 20548. So our additional sales will result in an additional account receivable balance of 20548. Okay, then class 2 into class 1. So class 2 receivable balance is 252,000, right? And 50% of this figure will be converted into class 1. Now there are two ways of converting this figure into class 1. One is the wrong way of doing it, and that is taking straight away 50% of 252,000 and adding it here. If I take 50% of this figure and just simply add in class 1, there will be no change to the overall receivable balance, and it would mean that there is no change to finance cost. Whereas when your customers will be paying us in 30 days instead of 60 days, it will result in a deduction of finance cost. So we can't simply take 50% of this figure and add it here. So what should we be doing? Just listen carefully. First of all, we have to convert. Remember, we have to convert receivable into sales first. And from sales, we have to convert it back to receivable. First of all, let's reverse this receivable balance and see the credit sales figure related to these receivable. Remember, the $252,000 receivable balance is equal to 60-day sales. And from 60 days, let us convert it into annual sales. 252,000 divided by 60, multiplied by 365. If I do this, it will convert the receivable balance into the sales balance again. So basically the sales amount related to this receivable balance will be equal to 1533000. Now 50% of this sales figure will now be paid in 30 days. So now again we have to convert this figure into receivable balance, but this time we will be converting it into a 30 days receivable. But first we should take 50% of this, because not the complete sales figure will be converted into 30 days. Only 50% of this will be converted into receivable balance. So let's first take 50% of this figure, and after taking 50%, convert it into a 30-day sales figure, that is multiplied by 30 and divided by 365. That's a bit complicated thing, but this is something that we have to do. So let me repeat it. Remember the class 2, this is the receivable balance and not the sales balance. So whenever we are converting a class 2 into class 1, first we have to convert this figure into annual sales figure. This figure is equal to 60 days. And in order to convert it into a sales figure, we have to convert it into 365 days sales. So what I did was I just divided 252,000 by 60 to get the daily sales figure. And then I multiplied with 365 to find out the credit sales figure related to these receivables only. Now I have got the annual sales figure. Of this figure, 50% of this customers will be converted into class 1. So I took 50% of this, and then I converted it into a receivable balance of 30 days by multiplying it with 30 and dividing it by 365. Now it is going to be 63,000. So that's addition to the class 1 receivable. Now the total class 1 receivables will be equal to the sum of these figures. That's total class 1. Now comes the class 2 receivables. Will there be any change to class 2 receivables? So class 2, the existing class 2 balance left will be 50%, because 50% of this has been converted into class 1. So just take 50% of this, 126,000, and then class 2 from additional sales. The additional sales figure was 500,000, and 50% of this was converted into class 2 and should be multiplied by 60 divided by 365. So it's 41096. So the total class 2 figure will be the sum of these two. Okay, is there any change to class 3 receivables? Is there any change to class 3 receivables? No. So class 3 receivable will be reproduced as it is. And there is no change to overseas receivable as well. So the total revised sales figure will now be That's revised account receivable. 743144. So what was the existing receivable balance? That will just be copied from the question. And that's 744500. So there is a reduction in account receivable, though it's a very minute difference of 1356, and finance costs will be, what was the finance rate? What was the finance rate? It was 8%. So the finance cost will be 8% of 1356, a very small figure of 108, but it's a good question for practice. It does involve some complications, but a very good question for practice. 108. That's the additional cost. So we can simply, so that's the benefit, sorry. There is a reduction. So that's a saving in finance cost. So I'll just reproduce this figure in the benefit section, saving in finance cost, and just refer to the figure here. So 108. So these are the two benefits of offering this policy. So is there any other benefit related to this policy? Bad debts. Yes, there will also be a change to the bad debts, right? Okay. So we have a total bad debts figure of 45,500 at the moment, right? And let's now calculate the revised bad debts figure and see if there is any change in the bad debts. So first of all, let's see what's the percentage of bad debts. So there is no bad debts. Let's say there are no bad debts related to class 1. So for class 1, there will be no bad debts, nil. For class 2, we have to calculate the percentage of bad debts, and that will be calculated by dividing 12,600 by the receivable figure to see what percentage of customers will turn bad debts for class 2. So the existing percentage of bad debts is 12,600 divided by 252,000. It's 5%. That's the existing percentage. So the receivable figure after the policy related to class 2 is 167,096. So 5% of 167,096, 8355. 8355. No bad debts to class 1. 5%. 5% of class 2. Since there was no change to class 3, so we'll just write 11,000 as it is. No change to overseas, that is 21,900. So the total bad debts figure will now be 41255. So we can say it's the revised bad debts figure. 41255, and the existing one was 45,500. So there is a reduction in the bad debts cost. So again, there is a benefit. So we can say saving in bad debts will be 45,500 minus 41255. So it's $4245. That's the benefit. So the total benefit will be contribution, saving in finance costs, and saving bad debts. 204373. Now, what will be the additional cost of this policy? What will be the additional cost? The discount offered. And the discount was already there. The 1% discount was already there, right? So we have to pick up the incremental discount offered. And the discount was only offered, remember, the discount was only offered to class 1 customers. It was only offered to class 1 customers, the ones that were paying in 30 days. So I'm just giving you 2 more minutes to calculate the discount amount that I should be including here. 2 more minutes for all of you to calculate the additional discount. And after 2 minutes, you people can take a 10 minutes break and we will be back with the discount calculation. So I'm just giving you 2 minutes to calculate the amount of discount, and then there will be 10 minutes break. Okay, back now. So I hope you people have calculated the cost of discount. Let me calculate it for all of you. First of all, you know that discount is only available to those who are paying within 30 days, and that's class 1. So let's first calculate the existing discount. The existing discount is 1%, but 1% to whom? To those paying us in 30 days. Now remember one thing, the discount percentage is always applied to sales figure and not to the receivable figure, because we have to calculate annual cost of discount and it should always be multiplied by the annual sales figure. Since we are only giving discount to those paying us in 30 days, so the existing class 1 customers are getting this 1% discount. So they have a receivable balance of 200,000. So we have to convert this $200,000 balance into the sales balance, sorry, sales figure. So we have to convert this from 30 to 365 days to find out the existing cost of discount. So 200,000 into 365 divided by 30. So if I just for understanding sake calculate this, it's 2433,333. That's the sales figure. This is the existing sales figure on which the discount is being offered, right? So if I multiply it by the percentage of discount, which is 1%, I will get the existing cost of discount, 2433. Okay, now the revised discount is 1.5%, and this is again given to those who pay us in 30 days. That is the class 1 receivable. Now after the policy, the class 1 receivables will be 283,548. So again, we have to convert this receivable balance into annual sales in the same way as we did here. The only difference is that the existing balance was 200,000. Now we have to use this 283,548 and we have to multiply it by 1.5%. That's the difference. So instead of picking up 200,000 for the revised thing, we have to pick the revised class 1 receivable, and for the discount we have to multiply it by 1.5%. So let me just copy this formula and paste it here, and let's write as revised discount, and just need to change this figure 200,000. It should be replaced by 283,548, the revised class 1 receivable, and we have to convert it into annual sales and then multiply it by 1.5% because the revised cost of discount is 1.5%. So it's 51748. So what's the additional cost? The difference of these two. That's the additional cost. So those who have come up with the same answer, excellent. So 2744, that's the additional cost. So let me just refer it here, and I'll just write less additional cost, and that's 27414. And let me write it as a negative figure and subtract from the benefit. So that's the additional benefit. Is there any other cost left? Is there any other cost that we need to consider? What's that? Is there any increase in fixed costs or what? No, finance cost. We have already considered the impact of finance cost. There was a saving in finance cost. Yeah, we have already considered the finance cost. In this case, it was a saving. So we are done with all the costs, and that's the net benefit of offering the discount. Right? Is it clear now? So my suggestion to all of you is, it's a very complicated question, but again, I would say it's a very good question for practice. So once the session is over and you get a time, just go through this question again. Since this lecture will be available on Vimeo Pakistan, ACCA Pakistan channel, so you can watch it again. But before you watch it again, just try this question yourself. This was a past exam question, though I don't expect the same level of question to be in the exam now, but you never know, because this is a past exam question. So just for a quick feedback, how is the session going so far from 1 to 5? Well, everyone who's asking for a repetition, because it's a recorded lecture, you will get a recorded version of this lecture, so you can watch it again. But in case you watch it again and you don't understand, you can always drop me a message and I'll respond to that, inshallah. Well, I've shared my YouTube channel link. You can also access lectures from there as well. So now let's move forward and let's quickly go through cash management, the last area of working capital management. Well, we have two models for cash management: the Miller-Orr model and the Baumol model. Now, what are these models? And a type of question that may be tested from this area will be, I guess it will be a multiple choice question coming up on these two models. Well, most of the organizations, when they feel they have surplus cash that they may not need for, let's say, 2 or 3 months, what they usually do is they invest that surplus cash into marketable securities. That is, investments that they can convert into cash by selling within 3 months' time. So they invest that surplus cash into securities or investments. And whenever they need cash, they sell securities and they realize cash, and then they pay for the transactions. But the problem will be when to sell the securities. Because if you sell it more often, it will increase your transaction costs. Similarly, if you invest more often, it will increase your transaction costs. So the frequency of the transactions should not be that much. So what should be the frequency? So there are two models that help us in deciding that how frequently the company should be investing or selling the securities, investing in securities and selling the securities whenever it requires cash. It requires cash. The first model is Baumol model. It works exactly like EOQ model. Just a quick recap of EOQ model. Remember EOQ model, economic order quantity. There we were having a problem of selecting the order size. And the EOQ model used to help us in deciding the most economic order quantity. That is, it used to help us decide what should be the order size that will ensure that the total costs are minimized. In that case, we were confronted with two types of cost, the ordering cost and the holding cost. So if the company were to increase its order size, it resulted in more holding costs, because if you order more units at a time, you will have to store more units and it will increase your storage costs. But on the other hand, the same will result in less number of orders being placed, and it will reduce your ordering cost. But if we reduce the order size, it will reduce the holding cost, but will increase the frequency of orders placed and will increase the ordering cost. So we used to use a formula that used to help us in calculating the economic order quantity, ensuring minimum costs. In the same way, a company in this case is faced with the problem of deciding how much value of investment should be sold each time to realize cash. Because if it realizes more cash every time it sells the security, it will be holding more cash. And by holding more cash, it will have to face it will have to bear additional finance cost of holding the cash. But on the other hand, if it does not sell a higher value of securities and realizing less cash, though its finance costs will be reduced, but it will be frequently selling its securities to meet its cash requirements, and this will increase their transaction costs. So instead of the ordering cost, we have transaction cost here, and we still have the holding cost here in the form of finance cost. So Baumol model will exactly work in the same way. The same formula will be used, right? And here C naught is not the cost per order, remember, it's the transaction cost. Each time a security is sold, the cost that the company will be bearing will be called transaction cost. D is the annual demand of cash, that is the annual requirement of cash for the business. And CH is the per dollar cost of finance. The per dollar cost of finance. Say, for example, if the finance cost is 8%, we have to put 0.08 here. So just quickly solve this question, and then I'll explain the answer that you may get. So go ahead and solve this question and find the value of X. And I'll explain what is meant by X in this case. Like it was EOQ. In the case of EOQ, it was the order size. Now what X represents here, I'll just explain in a while. Just calculate by putting the values. Yes, the right answer is 122,475, and let us calculate. Now we have annual demand of 3 million, the transaction cost of 150, and the finance cost is 6%. So let me do it using Excel. So the formula is 2 into transaction cost, which is 150, into 3 million, that's the annual demand, and whole divided by 0.06 as it's the finance cost. And then we have to take power as 1/2. So it's 122,474.5. Now what does this tell us? Here it means that whenever the company needs cash, it should go to the market, it should sell its securities worth of $122,474. That's a dollar amount. So the company needs to sell investment worth of 122,474 each time it needs cash. It's not the it's not the cash invested in one transaction, it is the cash realized by selling the investment. It's the amount of cash that should be realized each time an investment is sold. So by doing this, the company will minimize its overall transaction cost and finance cost. Is that clear, everyone? Okay, great. Okay, so we have another question. But before I move towards the next question, let's discuss Miller-Orr model. It's a very interesting model. Let's look at this graph and it will help us understand better. The Miller-Orr model works in a different way, but serves the same objective like Baumol model. It also tells us how much to invest and or how much to realize each time a cash is required. I will share these notes as well. Rida, don't worry. I will also share these notes as well. So just everyone just focus on what I'm going to explain now. This model says that every company should decide how much minimum cash it should hold based on its own requirements. So the company must decide it itself how much minimum cash balance it should always keep. Since every company will have its own requirements, therefore the minimum balance should always be decided by the management. Okay. Now from here starts the Miller-Orr model. Now, let's say we used Miller-Orr model and we calculated the upper limit, right? I'm just assuming. We are not calculating it at the moment. I will explain how do we calculate this upper limit in a while. But let's suppose we have calculated the upper limit, right? Now, let's say the lower limit is $20,000 and it has been decided by the management. And using the Miller-Orr model, we got the upper limit as well. Say the upper limit is $80,000. So the upper limit is now $80,000 and the lower limit is now $20,000. And remember that lower limit will be decided by the management and the upper limit will be calculated using Miller-Orr model formula. So it's 80,000. Then a return point will be calculated, and that's again going to be calculated using the Miller-Orr formula. And let me assume it's, say it is 40,000. The return point is 40,000. I'm just assuming all these figures, right? So remember, upper limit is $80,000. The return point is $40,000 and the lower limit is $20,000, right? Now, once we have calculated all these, what is going to happen? You know that from time to time, the cash balance of the company will fluctuate. Sometimes it may have more cash and the other time it may have less cash. So the cash balance will continuously fluctuate. Now, according to Miller-Orr model, you should not do anything with the cash. Neither you should invest or nor you should sell any security till your cash balance stays below your upper limit and above your lower limit. So when your cash balance in this case stays below 80,000 and stays above 20,000, you don't have to do anything. You should let this cash fluctuate within this limit and you should not be doing anything, neither selling or nor investing the cash. But there might be times when your cash balance may hit your upper limit. That is, you may reach to the 80,000 mark. Now, here is where Miller model starts functioning again. The moment your cash balance touches 80,000 mark, you should bring this cash balance down to 40,000. That is the return point. Now you have 40,000 cash in hand and you have to bring it down to 40,000. How we are going to do that? Who's going to tell me? Quick. How are we going to do that? How are we going to bring 80,000 cash balance to 40,000? Exactly. We have to invest in securities. And how much should we invest? Excellent. We should invest $40,000. We have $80,000 in hand. We should invest 40,000. And when we will invest 40,000, the cash balance will be reduced to 40,000, the return point. Right? Now, from there onwards, if it stays below 80,000, do nothing. But there will be times when your cash balance will be hitting your lower limit. That is, it will go down and down and down, and it will hit 20,000 mark. Right? So it will hit, the moment it hits 20,000 balance, 20,000 mark, we have to bring it back to 40,000 because it's the dangerous level. You may stock out anytime. So you have to increase your cash balance and you have to bring it back to the return point, that is $40,000. Now, how are we going to do that? Quick. We should sell investment. And what value of investment should be sold? 20,000, because we already have a 20,000 balance and we have to increase this 20,000 to 40,000. So we have to sell investments worth of $20,000 to realize 20,000 cash and add it to our cash in hand balance and reach to the 40,000 mark. And this is how Miller-Orr model works. Is that clear? Now, the point is how to calculate this upper limit. Why to wait for 80,000? We've got a question here. Because we think that keeping more than 80,000 or keeping 80,000 balance will be a loss of opportunity. You will be losing the investment opportunity because this is a very high limit for your business. So instead of keeping such a high level of cash, you should invest. Okay, again, we have a question. Why can't we invest any amount above 40,000? Well, 40,000 is what we usually need. You can say that's the average requirement. We may say that's the average requirement of the business. But if we keep exactly the average amount that we need, we will always be at risk of liquidity problems. So we should keep some buffer stock of cash so that we don't face the stock out situation. If you look at these fluctuations, these variations, if we keep cash balance of say 40,000, whenever this cash requirement goes up like this, we will be in a serious problem. Because we cannot, because if we excuse me, if we keep on selling so early or keep on investing so early, it will increase our transaction cost because we can't invest so frequently. Investing so frequently will increase our transaction costs. So let's now go to the formula of calculating this upper limit. Now remember, the difference between this lower limit and upper limit is called spread. So basically we have to calculate spread, and then we will add spread into our lower limit to get the upper limit. So what's the formula of calculating spread? That's the formula of calculating spread. We have transaction cost and variance of cash flows in the numerator and the interest rate in the denominator. So you must be aware of this formula. So I'm just giving you a question, and if you don't have this formula at the moment, just take a screenshot of this formula because I'm just giving you a question and you people have to solve and calculate spread. So take a screenshot if you don't have the formula. Okay, that's the question. Solve this question. Just forget about the upper limit at the moment. Just calculate the spread first. And then we will see how we calculate upper limit and how we calculate the return point. And remember, the question hasn't given us variance. It has given us standard deviation. So whenever you have standard deviation in the question, all you have to do is to just take a not square root, just take square of the standard deviation to get the variance figure. So you have to take square of 1400 to get the variance figure. So the spread will be 3 into 3 upon 4 means 0.75, right? So I'm just taking this 0.75 into the transaction cost, which is 50, into the variance, which is square of 1400, and raised to the power 1 upon 3, and whole divided by because the formula says we have to use variance, and the question has given us standard deviation. So variance is basically the square of standard deviation. And that's a statistical concept. We should not go into detail of that. So it's $20944, right? So how to calculate upper limit? Upper limit should be the minimum limit decided by the management, which is $15,000, and the spread, which is, so that's now your upper limit. So it means whenever your cash hits this mark, you should, did I use wrong formula? Did I? Oh, it's 8%, yeah. So I hope I have copied the question correctly. Okay. So yes, it's 8%, and it should be, sorry, it should not be here. I just put wrong brackets. Yes, 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 not per day. I'm just explaining. Just wait, just hold your horses. Just hold your horses. Let me first fix this formula. I always make this mistake of putting brackets around the formula. It's it's 0.75 into 50 into square of 1400 whole divided by 0.08. And now just hold here. So look at this. The standard deviation is 1400, right? But more importantly, the thing that you need to identify is this daily cash flows. If this figure is given on a daily basis, the interest rate that we put in the formula should be on a daily basis. In case the cash flow is on the standard deviation or the variance is on weekly basis, we should always put the interest rate on a per week basis. This is a key that you should all remember. This is going to decide what should be the interest rate. If the standard deviation or variance given is on a daily basis, then the interest rate should be of a per day. If it is given on a weekly basis, the interest rate should be on per week basis. If this is given on a per, yes, if this is on a per month basis, the interest rate should be a per month one, right? So what we have to do is we have to divide 0.08 by 365 to get the daily interest rate. Did I do another mistake? I did another mistake. This is what happens when you have so many brackets around Excel. Okay, let's first calculate the daily interest rate for simplicity's sake. So it's 8% divided by 365. And that's what you should put in the formula. Then we should have it in the bracket 0.75 into 50 into square of 1400 and should have brackets around it divided by this answer, and then we should have power 1 upon 3, getting close, and then we should multiply it by 3. My Excel sheet is getting corrupted. It's not giving me the correct answer despite I've applied this. Okay, I'll just check. There's some problem with my Excel sheet, right? So what is your calculator figure? What is your calculator figure? No, no, just tell me the calculator figure of spread. 20843, right? Okay, 20843. Now, the only thing that you need to remember is you should take square of 1400 whenever it's a standard deviation. And secondly, if it's a daily cash flow, you should always put an daily interest rate, right? You should put daily interest rate. These are the two things that you need to take care of. Then the answer will always be correct. So now we have got the spread figure. So now what is going to be the upper limit? The upper limit is always going to be the minimum balance plus the spread. That's the upper limit. So according to this question, whenever the company's cash balance reaches to 35,843, it has to bring it down to return point. Now return point, the formula for return point is the lower limit plus one third of spread. Remember, that's the formula of calculating return point, lower limit and one third of spread. So the lower limit in this case is 15,000. The spread is 20843, and we should take one third of this figure. That's your return point. So what does this mean now? So let me write it here. The lower limit. How will you explain? You most of the times, if this question is tested in the CRQ, it will be followed by a discussion. You have to explain what these figures mean to a business. So lower limit, that's 15,000. Upper limit and return point is 216. So now, so whenever the cash balance of this business reaches to 35843, it has to bring it down to return point by investing $13,895 whenever its upper limits is reached. It should invest 13895 to bring down this balance to 21947. And then whenever the cash balance hits 15,000, it should increase this cash balance to return point by selling the investment of $6947.67 to get to this return point. That's how you are going to explain this Miller-Orr model. So if it's an MCQ question, then it may ask for upper limit only, return point only, or it may ask for this investing amount or selling amount, either of these figures. But if this question is tested in the CRQ, which is least likely, but if it is tested in the CRQ, in the constructed response questions, you may have to explain all this. So is that clear? Yes, sure, I'll explain. The cash balance of a business will fluctuate, right? So in this company's case, whenever the cash balance reaches this limit, 35,843, this cash balance should be brought down to 21947. And this will only be brought down by investing the surplus amount of 13895 in the marketable securities. And whenever the cash balance goes down to $15,000, it has to be increased back to 21947. And this will be done if we sell a security equal to $6,947, so that the cash balance increases to $21947. Okay, let's take a 5 minutes break and we'll be back. Okay. Okay. I've got a questions now. Hassan Raza says, sir, please again tell me how to calculate spread. I did not understand. It's a formula. I don't know what happened to my Excel. Let me try again for you, and hopefully it gets through now. 3 upon 4, which means 0.75 into 50 into 1400 into 1400. Okay, then divided by 0.08 divided by 365 and raised to the power 1 upon 3. That's it. And then finally multiplied by 3. I guess the problem was with the power. Okay, it went through. I guess I was just putting a power somewhere wrongly. So I just changed it to 1400 into 1400. I've got the answer. SN, did you get it now? Bit complicated formula. That's why it's always dangerous to do it in one step. SN, are you there? So it's 20842. So that's it. We are done with cash management. We are done with receivable management, and we are also done with inventory management. So let's move towards what we were supposed to do on the second day, but got a bit late. Yes, Wasim, don't worry. I have a plan, which I'll make sure that we go through all the key areas of the syllabus. Don't worry. So let's start with investment appraisal. One of the most important areas of your F9. It's a backbone of financial management. So let's go through this question. PV company is evaluating an investment proposal to manufacture product W33, which has performed well in test marketing trials conducted recently by the company's research and development division. The following information relating to this investment proposal has now been prepared. Initial investment is of 2 million. Selling price, which is in current price terms, $20. Expected selling price inflation 3%. Variable operating costs, again current price terms $8. Fixed operating cost 170,000. Inflation 4% in the cost. And annual demand are as follows. It is expected that all units of product 3 produced and will be sold, and no inventory should be kept. No terminal value or scrap value is expected, and PV company uses nominal discount rate per year, 10% per year, and a target capital employed. So, so we have to calculate NPV, IRR, and return on capital employed, and discounted payback period. So everything will be covered in this question, right? So let's start with sales figure first. And we always assume that sales and operating costs will be occurring at the end of year one. So the sales will for the first year will be 60,000. So I'll just write 60 because I've put zeros here, into the price, which is 20, but it's the current price terms, which means that it's the price at point zero, whereas we have assumed that the sales will be occurring at the end of year one. So we'll multiply it by 20, and now I'm going to give you a shortcut of how you can inflate selling price by a simple formula. 60 into 20 into the inflation rate in price is 3%, right? So just put a power and link it with this one. Just link it with this one. So when we will copy this formula in the next cell, it will automatically change the cell reference from 1 to 2, and then 3, and then 4. So the powers will change automatically. So it's 1, 2, 3, 6. And let's copy and paste this here. And all we have to do is to just change the sales volume for every year. 7 instead of 60, it's 70 for the second year. No need to change anything else. 120, and then 45. So here we go, the sales figures. Less variable costs. Okay, let me repeat again. Just put 60,000 here, 60 into the price, and into 1 plus the inflation rate, which is 3%. Close the brackets, put a power sign, and just link it with the cell, and just press enter. So that's the sales revenue with inflation for the first year. Now copy the cell, select all these 3 cells, and just paste it here. Everything else has been adjusted except for the sales volume. That's what we need to change from 60 to 70, from 60 to 120, and then 45,000. Okay. Now comes the variable cost in the same way, but start with a minus sign so that the figures are written in the negative, with a negative sign. So minus sales volume, which is 60, into the variable cost, which is $8, into 1 plus the inflation rate in variable cost, which is 4%, raised to the power 1. 499. Copy and paste it here. Just change the sales volume. 60 to 70, 120, and 45, 421. Then comes fixed costs, which is 170,000. Bilal, I am linking it with the number of years because I am just putting the price as 20. That is the price at point 0. So after 1 year, it will be inflated for 1 year. For 1 year. After 2 years, it will be inflated for 2 years. Then the power should be 3 for 3 years, and then 4 for 4 years. So gain into 1 plus inflation rate 4% raised to the power 1. So it's 176,800, and let's now copy. It will automatically inflate the fixed cost. See, it's inflating. So we don't have to do anything. Just put the right formula in the first cell and everything else will be done automatically. And that's what the beauty of spreadsheet is. This is what spreadsheet is used for, to make lives easier. Though sometimes it does put a problem like it did a while ago with me. Okay, no problem. I just need to remove zeros. Why did we inflate fixed costs? Because the question has given us inflation rate of 4% for all operating costs, including fixed costs, because fixed cost was reported in current price terms. Why do you people think that the fixed cost should not be inflated? Look at this. Fixed operating cost, current price terms, $170,000 per year, which means that it's reported at point 0. So, and it says that the operating cost, it does not state whether the operating cost is variable cost or fixed cost. So it means that this inflation rate applies to all operating costs, whether it's operating cost or variable operating cost. Okay, so all operating costs have been taken into account and there are no tax allowable expenditures anymore. So just $560. Okay, these are called pre-tax cash flows. Pre-tax cash flows. Now we need to apply tax rate if it's there in the question. Do we have? Yes, it's the tax rate. Do we have a tax rate? No, it says ignore inflation. So it's ignore taxation. So it's a very simple question of NPV. So no working capital, no scrap value, and no taxation. So we can call it as our net cash flows. We don't have any other cash flows. Now comes the discount factor. The discount factor should be at the rate of 10%. Yes, we can write investment here or we can subtract it at the end. It's up to us. So if you want me to write it here, so I can, let me write it. Otherwise, we can always deduct it at the end. So the investment is of 2 million. It's 2 million. So now let me give you a shortcut of how we can calculate discount factors. Right? So just everybody just focus on it. It's a very important one. Let me give you a shortcut of calculating discount factor. 1 plus 10% raised to the power minus, and just link it with this zero like we did it in case of inflation, but with a minus sign. Don't forget to put minus sign in case of discount factor, right? So okay, now let me copy it here and let me increase the decimal places. So here we go. We have got the discount factors for 10%. So just look at the formula. 1 plus 10%, bracket closed, power, minus, and just link it with here. And when you enter, you will get this, right? For year 0, it's always equal to 1. Now just copy this formula, and you don't have to do anything. Just select these cells and copy it. You will get discount factors for all the years. Now calculate present values. Cash flow into discount factor. Cash flow into discount factor. And then copy and paste. So we've got net present values, and now let's calculate net present value. Net present value will be sum of all these. Since the investment is already written as negative figure, so it will automatically subtract it. That's NPV, and the figures were in thousands, so we should write that's it, approximately 368,000. That's NPV, net present value. Is it clear? Wouldn't using formula be better? Rida, since I haven't used the real worksheet on the exams, but as far as I know, they have only allowed basic uh, Excel functions like sum or subtraction or power. I think disabled the complicated formulas for NPV and IR. So in case it is allowed, you can use that NPV formula in the exams as well. Well, Asher, on Excel, it does not make any difference. On spreadsheet, it does not make any difference. The figures, if they are just different because of rounding off, it won't make any difference. Let me increase the decimal places. Look at it. See? So I can just write it this way as well. So the examiner can easily check the exact figures. So no more a problem on spreadsheet. Okay, now let's calculate IRR. For IRR, we need to increase the rate so that we get a negative NPV. But I really doubt, because the NPV is so much positive that I doubt whether I'll be getting it negative at even at 20%. But let's try and calculate NPV at 20% cost of capital, so discount rate. So 1 plus 20% raised to the power minus 0. And let's copy and paste here. So, and increase the decimal places to see the exact discount factors we've got. And let's calculate present values at 20%. So again, let's multiply the cash flows with the new discount factors, 560 into 833. And let's now calculate another NPV. Yeah, luckily it's negative now. So the IRR will be the lower rate, which is 10%, plus the positive NPV divided by the positive plus the, sorry, minus the negative NPV into higher rate minus lower rate. 18.24% is the IRR. So the internal rate of this project is 18.24%. That is, now let's understand the concept of IRR as well. Positive NPV means we should invest in the project, because if we invest in this project, we will have a surplus of 368,000. Excuse me. Internal rate of 18.24%. What does this tell us? This tells us that if you discount this project at 18.24%, your NPV will be zero at 18.24%. So this project is even acceptable if your cost of capital is 18.24%. Or in other words, you can afford to give 18.24% return to your investors if you undertake this project. But our but whether our investors are asking for 18.24% return or not, no, they are not. Our cost of capital at the moment is just 10%. And this project can help us to pay even 18.24% return to our investors. So should we accept this project or not, looking at IRR? Should we accept or not? Should we accept this project if our IRR is 18.24% and our cost of capital is just 10%? Yes. Right? So, okay, James, let me check. Is it for every year? James, you have to check it at your end. I think it's correctly calculated at our end. Sales volume into the variable cost into 4% inflation and into raised to the power 1. Okay, the year 4 should be higher. Okay, it's 45. It's into 8. It's 1 plus 4 and raised to the power n 4. No, it's okay because the sales volume is lower. Cheyenne, it does not make any difference. The 20% is okay. It does not make any difference. So we are done with the IRR. So yes, you can see the working of IRR. So excuse me. I have to end the session because I was not feeling well before the start of the session today. But since I did not want to waste your time, I had to take this class. But I'll be just giving you a home assignment. Just try the duo company question here. Don't try any other question, just try the duo company question. And also calculate payback period of this question, and solve the duo company question. So to save time, what I'm going to do is I'll just record the video tomorrow and upload the video of duo company on Google Classroom. So it will save our time and we will just pace up our speed. Thank you so much. And I'm sorry my health condition wasn't good today, but hopefully I recover it tomorrow. Thank you so much, everyone. Hamza, don't worry. Even if I put it on the Google Classroom, it will be saved there and you can access it anytime, any point of time. Thank you so much, everyone. Thank you so much. Okay, have a good day, everyone.